When you think safe withdrawal method, what do you think of? Are you thinking birth control? That's often the statement we get confused with. It can often result in unwanted circumstances. But what does the safe withdrawal method have to do with financial planning? Well, it's a different type of safe withdrawal. We're going to talk about the safe withdrawal method, how that method exposes you to traditional financial planning mistakes and problems. And we're going to try and understand these problems that you are likely not even aware of and how to fix them. The safe withdrawal method, it's the rate at which you can safely withdraw a certain amount of your wealth in retirement and eliminate or reduce the risk of running out of money. This chart shows what the chances of you not running out of money are depending on your withdrawal rate. So if we look at the first row, you being in retirement for 30 years and you taking out 4% of your money, you see the chance of success is 94.8%. Now, if you were to bump that up to 4.5% of your wealth, your chance of outliving your money would increase, right? Your chance of success drops to 82.6%. If you're in retirement for longer, so let's say you retire at 50 and you're looking at 40 years of retirement and you take out 4% of your money, your chances of success are 84.4%. I, for one, would not get into a plane if the pilot tells me, just to let you know, we've all fueled up and we have an 84% chance of making it to our destination. Would you get on that plane? We want financial plans that are going to have high degrees of success. I want to go over the reasons why the safe withdrawal method is really no method at all, and why those numbers are so low. The first reason is taxation rates. When we are in retirement, we are likely going to actually be in higher taxation rates. And I know that that goes against what traditional financial planning methods say, but traditional financial planning is broken. When we see inflation rates go up, we're going to have to take more and more of our money. Also, the governments are in big problems right now. The deficit grew through COVID over 57%. Not only that, interest rates are higher. So the cost of that debt and the deficits are higher for us. So what's that really mean? Well, we're already seeing things. Who here has experienced higher property taxes? The increased cost of servicing that debt for the government is getting pretty hefty with all those hikes that we had. We had 10 hikes, I think, in less than 12-month period. We hear things like they talk about the Canadian basic income benefit. They talk about a nationalized pension plan. Our healthcare system is absolutely on the brink. And this last budget that came out, they launched a grocery benefit. They launched a dental benefit. Who's going to pay for all these benefits? I mean, believe me, I think it's fabulous that Canadians are all going to have pearly white teeth. But who is going to pay for all those benefits? We hear time and time again, the rich getting richer, the poor getting poorer. But the poor, the less fortunate, are starting to protest and riot all over the world because of their standard of living. The risk of taxation increasing is very severe. If you are a high net worth individual or a high income individual, you have a target on your back. Because where is the government going to go to get that money? They have to go where the money is, which is high income earners and high net worth individuals. Just this last week, I'm hearing property taxes all over the country are going up. Rates of 5, 6, 8. I heard Victoria was 10%. The second reason that traditional financial planning is broken and the thing that affects the safe withdrawal rate is inflation. Inflation is going to absolutely destroy the purchasing power of our dollar, which means to just have the same standard of living, we're going to have to take more and more money out of the pool of wealth that we've accumulated. It will often mean that we're going to be going up tax brackets, which means our tax rates will be higher. This is a chart that would show someone age 65 taking $100,000 out of their nest egg in retirement. Now, with a 2% inflation rate at the 11-year mark, that is only got the purchasing power of 80,000. So your purchasing power has diminished by over 20%. If we were looking at a 5% inflation, and inflation is coming down, I'm hoping it's going to continue to come down. I don't know if we'll hit the 2%, but a 5% inflation rate, let's look at year 10. We've reduced our purchasing power by 40%. If you have to take out so much more just to maintain the same standard of living, you're going to have to take out more, which is why it's affecting the taxation that you pay, and it's affecting the safe withdrawal rate because you're not taking the same amount, right? You're increasing it. The third thing is what we call safe money. Now, when you're in your 40s and 50s, you might like buying real estate with 20% down. You might like investing in the stock market, but think of your grandparents. Okay. What did your grandparents invest in? They were maybe more GIC people, right? They want safe money. And when you turn 70, when you turn 80, you're going to want to have safe money. Well, a GIC will rarely beat the rate of inflation. So because you're going to have a chunk of your money earning very little return, if you're not going to get the same return that you do in your riskier periods of life, that is going to affect the safe withdrawal rate. The fourth thing is life expectancy. As we sit down, we're 65 and we're sitting down and we're trying to plan how much money can we take out. And our life expectancy is, let's say it's 85, it's an average life expectancy. Half the people make it to 85, but half live beyond. We obviously don't want to run out of money. So we might try and make our money last to age 100, which means we have to take out a much smaller proportion of our money. That's affecting the safe withdrawal method. I would really appreciate it if you would like this video and subscribe and maybe even share it. This will help us to grow our channel and to share our message with more Canadians. The fifth thing is market volatility. You see, when you're in the accumulation phase of your life, you can be paid to wait. If the stock market pulls down or you see a real estate crash, that's okay because you can wait for it to rebound. But when you depend on that asset to live off of, and you plan on selling stocks, withdrawing from RSPs, or selling a piece of real estate or refinancing it, you are forced to pull out money potentially when it's lower. So that same 100,000 is not going to give you as many $100,000 units if the stock market is down, if the real estate market is down and you have to sell. Now that you know what the problem is, the safe withdrawal method, and you know all of the factors that affect it, taxation, inflation, life expectancy, the need for safe money, and market volatility, how are you going to fix the problem? The better solution that we work with you on as infinite banking practitioners is to use an infinite banking policy. You still have liquidity, use, and control of your money. In addition, you have a tax-advantaged storage of wealth and a tax-advantaged income in retirement. It's a benefit that can be tax-free on death. The values can only increase. So now you have this safe asset that can only increase. Every year a dividend is paid, the death benefit increases, every year a dividend is paid. And the insurance companies that they work with have strong histories of always paying dividends. It's also extremely inflation friendly because every dollar of premium that you pay into the policy each year buys more cash value and more death benefit. And the cash value actually chases the death benefit so that in the later years of your life, the growth is exponential in terms of the cash value. It's also an amazing asset that is completely separate from the stock market, completely separate from the real estate market. So you have this diversification tool. And the entire time it's accessible for you in terms of accessing the cash values. Typically, we recommend collateralizing the policy or a policy loan. It's true peace of mind. An infinite banking policy truly works in all phases of your life. During your wealth building years, it's an amazing place to store your wealth, to grow your wealth on a tax advantage basis. But the entire time, you have liquidity, use, and control of your money in terms of being able to access it through policy loans typically. Now that you enter retirement, it completely takes away all of those risks of a safe withdrawal method, right? Because it's not attached, doesn't have market volatility. It's not attached to the stock market or real estate market. It can be tax advantaged. So you've eliminated or reduced the taxation risk. It's inflation friendly because each premium buys more cash value every year and more death benefit. And you can't outlive this asset. In fact, the longer you live, the greater the cash value and death benefit growth are. It will allow you to spend down other assets and have that capital completely replaced. And then, of course, it works at death because it's a tax-free benefit to your beneficiaries. Whatever you haven't already utilized of your death benefit, because you can borrow up to 90% of your cash value, is accessible as a death benefit. Is your financial model right now more resilient or more vulnerable to the safe withdrawal method? Are you more vulnerable to increasing tax rates, to inflation, to stock market volatility, to outliving your money? And would it be better for you to save your money, to store your wealth in a different mechanism, in a different place? I encourage you to reach out to IBCanadagroup.ca, go to the contact page and fill out some information, and you will be put in contact with a licensed infinite banking practitioner.